Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500. We've had quite a rapid drop over the past couple of days. A lot of investors, a lot of viewers are starting to worry, expecting a much larger drop on the stock market. We've had quite a few very interesting developments happen over the past few months, and it's becoming an increasingly popular narrative that we're forming a long-term top right here, potentially already having peaked. We're going to discuss that in this video, whether we think that's a likely scenario. We're going to discuss a few very important concepts in this video. If you are new here, make sure to smash that subscribe button if you haven't already. Also, don't forget to click on the like button if you enjoyed this episode, if you learned something new, if it helps you in any way. Now, without further ado, let's get right into it. All right, so one of the big developments that we've had over the past few months is TLT. So is TLT heading higher? So I've put a chart of TLT here. This is the Treasury Bond ETF, and you can see ever since March 2021 here, we've seen a rally in TLT. A lot of investors, a lot of macroeconomists who are expecting deflation are very excited about this rally right here. Now, the problem for equities is that when you see a rally in bonds, it often precedes big market peaks, right? You can see back here in January here, you had a very similar development, a rally in TLT, in the Treasury Bond ETF, in the months right before the big COVID peak. You also had similar types of developments right before the great financial crisis. It's a sign that market participants are heading into safety, right? Treasury bonds are safety before a big deflationary event occurs. And one more development that's worrying a lot of investors is on this chart right here. So I'm going to divide the S&P 500 by the M2 money stock. This is a chart that we've taken a look at before right here, and I do believe it's a very important chart to look at. It puts the equity markets in proportion to the total money supply, and I think that's essential to do in the current monetary environment with the huge expansion of the money supply. So you can see what's happening right here. As we've had this rally in 2020 and 2021, we've smashed right into that resistance level right here that we reversed off back in February 2020. So could we be seeing a double top here on this chart of the S&P 500 divided by the money supply, with both setups having the bond market rallying leading up to that top? We're going to discuss that in detail in this video, but I first quickly want to discuss the technicals of the S&P 500. After all, this is a channel that focuses on the technical picture because that's going to help you put in perspective what the trend is the general trend up or down, and what types of opportunities can we take advantage of in that trend using strong lines of support and resistance. Now you can see the most recent developments. We've been trading within this nice price channel. We identified this price channel using these reactions right here. It's been respected perfectly ever since. So that's the first thing that I just want to say here, that this correction right here is somewhat of a very healthy correction, right? This is just a reaction of resistance. We're still within this price channel. We still have a nice level of support right here. So we have no technical breakdown in the price structure. This is just an overall healthy trend right there. So just from a technical analysis standpoint, we're in a very bullish structure. We had this major breakout right here, breakout back test here. I'm not going to get into the details of this, but this was a major long-term level of resistance that was broken back here in March 2021. And we've been trending violently to the upside ever since. Now you have to watch out, because if we delete this channel and we try to find another nice price channel, we also have these reactions right here from this bottom right here on May 2021. This reaction right here, you can see that could actually act as a nice level of support if that gets tested. So this is the zone that I'm looking at for this bullish structure to hold. These are the two big levels of support on the S&P 500 in the short term. If that starts to get broken, then we're looking at a deterioration of the bullish technicals, and that's exactly what we're going to discuss in this video. Is that a likely event, or should we be looking to step in and buy at these levels? Because if we take a look at what was happening back in February, we also had a relatively bullish structure, right? We can quickly identify a nice price channel here. That was a bullish price channel. Everything was healthy right up until this very moment in 2020. So that's where the bond market that we discussed just a couple of minutes ago is going to give us some big answers. So let's take a look at how the bond market, so TLT, how it was behaving throughout this period in January and February 2020, and how it's behaving right now, and whether it's similar or completely different, and how we're currently reading that. So we've definitely had a nice run here on TLT since this March low in 2021. So really showing us that investors are seeking safety here into the bond market, right? And you can see that's a similar type of move to what we had between November 2019 and February 2020. We had a similar type of move in the bond market telling us that investors were looking for safety here. So a lot of deflationists are getting excited about this move right here, but what they are probably missing by not using technical analysis is the recent developments we've had right here. You can see what happened on TLT just over the past couple of weeks. We've had a breakdown here, backtest. That's a bearish development. We had a nice, well-defined uptrend line here. We had a breakdown. So that's not giving me a particularly bullish bias on TLT right now. And if you take a look at the Fibonacci retracement levels from this high right here to the low we just had in March 2021, and you take a look at where TLT reversed, that's the 50% retracement level right here. So why is that important? Because one of the big concepts in technical analysis is that you have counter rallies and counter trend corrections during an ongoing trend. So you can see right here, you had a big leg down on TLT. The ETF was oversold. Bearish sentiment was excessive here. You need a counter trend rally, and that's exactly what we got. And so seeing a reversal of the 50% retracement level tells me that this rally could still be within a counter trend rally type of scenario, especially after getting a breakdown and backtest here. That downtrend, that's something that we expect. I'm going to discuss in detail why in this video, but that's not at all the same picture that we had back here in January 2020. You take a look at the Fibonacci retracements on that move down. You know, we were already at 0.786. That's not a typical retracement level. And if you take a look at the trend at that moment, we were still within a strong trend. We did not have any type of breakdown in the technical structure in this zone here in February 2020. So now if you want to keep it simple and just dumb it down to one signal, you can also use the 200-day moving average here. So this is a very important level of support. You can see right here acts as support throughout that rally here, acts as support right here. So you can see what happened. We recently just popped above it. So that's a generally bullish development here, but we're still below that 50 retracement level. So we're sandwiched between support and resistance. If we break out here, that starts to look bullish. But if we make a false breakout here and break back down below this 200-day moving average, that starts to signal a potential larger move down in bonds. Now, from a macro standpoint, I do have a couple of charts to show you guys. This is a very interesting chart that I found on Nordea Research, and they show you the apartment rent for recent movers here, and that compared with the US CPI primary and owner's equivalent rent that actually represents 40% of the core CPI. Now, you can see what's happened recently in the past few months. During the pandemic, we've seen that portion of the CPI come down significantly, and it hasn't bounced back like most of the other CPI measures. Now, that's in large part due to the eviction moratorium that's been keeping these prices down. Now, what this chart shows you is that that's likely going to be coming to an end as soon as that eviction moratorium disappears. So that could actually hold up inflation for quite some time here. You can see the red line on this chart is the inflation rate that's at around 5% right now. That could actually hold up for another few months before eventually coming back down and actually potentially heading into deflation somewhere in 2022. Now, in the next video, I'm going to discuss further examples of what could actually keep up this inflation rate going for another few months, another few CPI readings before it eventually comes back down. But the point I'm trying to highlight on this chart here is on this blue line here. Look at the real interest rate for holding bonds. It's at -5%. So bonds right now, treasury bonds, are in negative territory. They're extremely unattractive to hold. Meanwhile, we have a fourth stimulus check coming that's going to further devalue currency. So if you're a bond holder right now, a foreign US bond holder right now, and there's a lot of foreign investors holding US bonds, and you're seeing these stimulus checks appear, you're seeing the inflation rate at 5% with the nominal interest rate extremely low, well, you're going to start to sell your bonds. So I do think that we're going to start to see a lot of bond sellers step in here on this counter trend rally for another move down in the bond market before we eventually see the deflationary narrative take hold once the Federal Reserve begins to taper in response to those bond prices falling. So why is that important? Why am I discussing all that? First of all, just to highlight that this is a very different environment to what we had throughout this period here, and also to open the debate that if we have a sell-off in the bond market here, that would be extremely good for equities. Let's zoom out on this chart just to remind you guys. This is a weekly chart of TLT, and I'm going to put up the S&P 500 on top. We've shown this many times on this channel before, but the strong inverse correlation between bonds that go up when stocks go down and bonds go down when stocks go up. And that repeats over and over again. So if we see another sell-off in the bond market into the end of the year, could that push the S&P 500 up to 5,000 points? Absolutely. So that's something that we're closely looking at. We're watching the bond market. Right now, we still have a bearish bias on the bond market. So our target for the S&P 500 for the end of the year remains at around 5,000 points, which is why we'll be looking to buy the dip at these levels, at these strong levels of support with a nice stop loss below. Now, in the next video, I'm going to discuss the recent developments on the sentiment that's been declining. A lot of investors are bearish on the markets right now. What does that mean for the stock market? We've also had the dollar start to rally, so that's an interesting development that we're going to take a look at in detail. Now, in the meantime, I wish you good luck on your trading and see you next time.